how can we profit from the Cake token price collapse? And what's actually causing that collapse? What are the tokenomics? How is supply? How is demand being influenced? And how can we set up a trading strategy to profit from this overall bearish momentum, and this especially bearish momentum for the Pancakeswap token? But first things first, when we look at the top 100 coins in terms of market cap, we see that the Pancakeswap token, the token with the ticker symbol Cake, it's been declining very, very heavily, right? The most in the last 24 hours, but also in the last week, it's one of the top losers. And so this begs two questions. First of all, why is this happening? And second, how can we make money from all of this bearishness? The Cake token is the native token of the decentralized exchange Pancakeswap, right? It's one of the largest DEXs. It's the largest DEX on the Binance Smart Chain. And over here, we can, as with any decentralized exchange, swap different tokens, right? This is a fork of Uniswap. There's now probably hundreds of different decentralized exchanges. Pancakeswap is one of the largest. And what does the Cake token here do? In order for these DEXs to work, in order for these decentralized exchanges to work, you need to deposit liquidity. There are investors that lock up their money over here. They go here to farms and they provide, for example, BUSD and BNB or Raka and BUSD or whatever kind of token there is. There's always a liquidity pool. 50% of the capital is in one token, the other 50% is in the other token. And so when you go to a decentralized exchange like this, you swap against such a liquidity pool. This is different to, for example, Binance, right? In Binance, you've got an order book, you get directly matched with another party on the centralized exchange. For decentralized exchanges, you don't have order books. You've got liquidity pools and you put in one token on one side and you take out another token on the other side. This creates an imbalance within the liquidity pool, which then leads to adjusting prices. And the reason why you want to provide liquidity to such a pool, so for example here in the BUSD BNB pool, the reason why you want to provide liquidity, why you want to put money in here, is because you can get a return on this. You can get an APR. And how is this generated? It's generated by the swap fees. So besides the gas fees that you pay to the miners that operate the blockchain, you also pay a fee to the centralized exchange. So when we look at this in more detail, for each swap you pay 0.25% of trading fees. That's for Pancakeswap. For other decentralized exchanges you might pay more or less. And 0.17% of that trading fee goes to the liquidity providers, so the people that put in money in the liquidity pools. Some of the fee goes to the treasury, some of the fee goes to buying back Cake tokens. Now that's interesting, right? When you provide liquidity over here, what you're actually getting is not a return denominated in BUSD or in BNB in this example. The return will be generated in Cake tokens. So over time, when the money is locked up over here, you generate Cake tokens and you can then sell those Cake tokens for whatever stablecoin or volatile asset you want. This is how you get paid your reward. And so this is the first piece of the tokenomics. Supply hits the market by people providing liquidity in the liquidity pools. Now, on the other hand, you've also got a burning happening here, right? 0.05% get burned. So the decentralized exchange itself, it's buying back tokens and it's burning them. But as a net, more Cake tokens come out than go in, right? 0.17 is more than 0.05. So over time, Cake is an inflationary token. More and more tokens hit the market, which will then over time depress the price. And that's a mechanic we can basically find for any DEX token, for any decentralized exchange token. Very often we see those tokens over time declining in price because the supply is simply increasing and there's not enough other utility behind that token that could push the price up. Sometimes things can get a bit more complex. So for the CRV token, for example, that's the DEX token of Curve Finance. You can also use this for voting, as in what liquidity pool should get the most rewards assigned to it. So there's also some kind of bribing mechanism happening where you can then get bribe yields by staking your tokens to another application. That goes beyond this video. Over here for Cake, simply take it as it is. Cake is inflationary, thus depressing the price over time. There are a few mechanisms that try to hide this somewhat, right? For example, you can stake your Cake. So you can refrain from selling your Cake tokens and get an additional APY. These APYs are relatively high, right? 61% per annum. So when you put your Cake into this vault, you will get more Cake over time back. But very often the inflation, it outpaces that APY, which makes this very often not worthwhile. This here is the US dollar chart of Cake, and betting on falling prices over here might be scary somewhat because sometimes we do have massive rallies over here, right? 300% over here. This here was a 130% rally. And the reason why these rallies happen is there's simply overall positive momentum happening in crypto, right? There's quite a bit of correlation. And when we look at this rally over here and we look at Bitcoin also went up during this time, right? When we look at the exact low point here on the 19th of July, this was also the low point here for the Cake token. So there is correlation. These charts don't mirror one-to-one exactly, but still, when all of crypto is going up, the Cake US dollar price might also go up. So a simple short versus the US dollar is probably not going to be too safe. Nobody knows if this current negative momentum in crypto will continue. If an overall rally happens, then you can't count on the Cake token continuing to go down. So we have to get a bit more complex here. We have to trade a different depreciation. But before we go into the details of that setup, if you so far enjoyed this content, feel free to subscribe because I publish videos daily. So first, let's look at this conceptually. What do we actually want to short here? What do we want to bet on? The US dollar chart is pretty dangerous. It does have its rallies. But when we look at relative performance, say Cake versus Bitcoin, this is a bit less risky, right? This also still has quite a bit of a rally. This is 380%, but maybe we can find something with less volatility. What about Cake versus Ethereum? Now this looks more of a constant downtrend, right? This doesn't look too dangerous. If we bet on falling prices, you've got pretty much a constant bleed. There was this initial rally, it's less, right? It's 200% in this case. But since we picked up this negative momentum in April 2021, the maximum rally we got over here was 40%. It's still not nothing, but still, that's a massive depreciation in the long term, right? From top to bottom over here, we're looking at an 85% decline, which could potentially be pure profit when you're betting on falling prices. Let's look at Cake versus BNB. Now that's interesting, right? This is a maximum rally of maybe 73%. If you take the absolute worst, maybe 93%. That's all there was in terms of upside versus BNB. And that's here all this downside, right? This destruction of capital, basically 75% loss, and that loss is pretty constant. So let's try to set up a strategy that benefits when this chart here continues to go down. Now what we want to do is we want to take on a loan denominated in Cake tokens, and we want to buy BNB on the other side. So when Cake depreciates versus BNB, we will gain. The idea is you take on a loan, you swap your Cake versus BNB, you wait for Cake to further depreciate versus BNB. Once you're happy with your gains, you swap it back again. You swap your BNB into Cake to pay off that loan. And when Cake did depreciate, then you will need to swap less of that BNB back into Cake, right? Because BNB is more expensive. All the BNB that you've got left is then your pure profit. That's how you want to set this up. And so how can we do this? We can go to a borrowing and lending platform. Again, decentralized, right? So we go to DeFi Llama, click on categories, click on lending, and then go to the Binance Smart Chain and look at the different lending protocols. Where can we borrow denominated in Cake tokens in order to then sell these proceeds? So I went through this list, and what I found is that Venus and Wing Finance both offer this. Now Venus is way less risky, right? It's got a total value locked of 1.4 billion, but if you look at both over here, Wing has only 52 million. Feel free to do your own research if you want to take on the risk of a smaller platform. Feel free to also look at different kinds of assets that you might want to consider shorting and betting on falling prices. So let's go to Venus. You always want to go through a platform such as DeFi Llama to go to this page, right? So you click here on Venus and then you click on website. You don't want to Google for the platform because then you might get a fake website and you might get scammed. So make sure you got the right link. This is app.venus.io. And in here, when we click at market, we can see we can borrow in Cake. So here's the borrow APY. Here's the supply APY. So borrowing in Cake here costs 45% per annum. Now, if you want to borrow over here, we always have to provide collateral. And so you need to consider what kind of other asset do you want to provide. And this is probably depending on, first of all, what do you have? But second, what kind of APY can you get for providing? For stablecoin, for BUSD, you get 3% natively on your BUSD. You also get 0.5% paid in the Venus token over here. For BNB, you get in total around 2%, right? 2.1 when you add those two up. All of these numbers, they are fluctuating. So provide whatever you feel comfortable with holding over the long term. This doesn't have to be BNB, right? The BNB comes in at a later point. Let's say you've got BUSD, so 3.5% is what you earn. This is what you deposit, maybe $1,000. Then you borrow against that. You borrow the Cake token, so you get rewarded 1.3%. You also get the 3.5% from lending out, so that's plus 5% roughly. And then you pay 45% in interest. So net, you maybe pay around 40% or so in interest, right? That's the cost per annum of opening that position. That's the minimum you have to expect Cake to depreciate in 1 year. And so how do you do this in practice? You click here on dashboard, then you click on supply market, you click on BUSD. You first have to enable supplying the BUSD to the platform. Currently in this wallet, I don't have any BUSD. You enable this, you provide the liquidity. Then afterwards, you have to enable this collateral switch over here. So your BUSD can act as collateral. Then you click on borrow market. You borrow denominated in Cake tokens. So that's over here. You say how much you want to borrow. Ideally, you don't want to put this number too high, right? The UI will give you a warning of what's safe to borrow. So for something as volatile as Cake, I'd probably not borrow more than 50% against the collateral that you've deposited. You click on borrow, then you've got Cake in your MetaMask wallet. What you then do is you go to Pancakeswap and you swap your Cake for BNB, right? We want to be long in BNB and short in Cake. So then you've got BNB, and what you can then do with those BNB is you can again deposit them here in Venus if you want to get this APY over here, and to also use this as collateral, right? Because if the position goes against you for a period of time, you rather have too much than too little collateral. What you can also do alternatively is try to find places where you can get a higher APY than 1.4, which there is plenty on the Binance Smart Chain. That really then comes up to individual preference. So that's how you could set something like this up. I personally haven't done this yet, but I've set up something very similar for Chainlink. So when you look at the Chainlink to Ethereum chart, actually, let's just do that. Here, this is the long-term Chainlink to Ethereum chart. I am bearish on Chainlink versus Ethereum. So I went to the Polygon blockchain, and then I went to Iron Bank, which is another DeFi lending protocol. I deposited stables, I borrowed Chainlink, I sold the Chainlink, I bought Ethereum, or in this case, I actually bought Bitcoin because I'm more bullish on Bitcoin than I am on Ethereum. And so I'm now profiting when this relative rate here continues to go down. If you're interested in what kind of trades I do and what kind of strategies we can deploy in order to gain in this bearish market, feel free to check out the premium membership here at thebitcoinstrategy.com. Link is also in the video description. If you're wondering what kind of stablecoin to hold, for example, as collateral, what are the risks of different stablecoins, then this video over here might be for you. Thanks for watching and see you next time. Bye-bye.